to the explainer. Look, if you've been itching to jump into trading just because it feels like literally everyone around you is getting rich overnight, well, you're in exactly the right place. Today, we're cutting right through the hype and looking at the absolute raw, brutal reality of the stock market. You know exactly what I'm talking about. We've all seen those online investment calculators, right? Especially the ones for SIPs, systematic investment plans. They promise massive, completely effortless wealth, and honestly, they give beginners some serious FOMO. You plug in a few numbers, watch a slick little animation, and boom, suddenly you're a future tycoon just waiting to collect your cash.
They totally tempt new investors into thinking that just blindly throwing some money at the market is going to magically turn into 100 or even a magical 1,000 crores. It's crazy. It creates this powerful psychological trap where the market just looks like a guaranteed ATM, completely detached from how real-world businesses actually grow.
But here's the thing, jumping in completely blind, without a solid strategy, it is absolutely dangerous. And today, we're going to uncover exactly why. We are zooming right past the social media hype to look at the raw, unfiltered data that those viral posts always conveniently seem to leave out.
So, Part 1. The crash. The brutal reality of market returns.
Look closely at this historical data. An investor jumping in during 2008 saw literally 50% of their portfolio vanish in year one. 50%. Naturally, that triggered massive panic selling. But contrast that with 2020, where new investors got an immediate 16% bump. Your starting line radically alters your psychology, kind of tricking you into feeling like either a total financial genius or an absolute failure.
And over the long haul, the market is incredibly chaotic. Get this, even investing the exact same 10,000 rupees every single month for 15 years yields wildly unpredictable results. We're talking a massive range, from 89 lakhs down to just 46 lakhs. And that's based entirely on when you started. Same exact money, same time frame, completely different outcomes.
So the absolutely crucial takeaway here is that you've got to be mentally prepared for 20 to 30% drops. It's going to happen. When the market flashes red, the absolute worst thing you can do is hit the panic button and lock in your losses. Patience. Honestly, patience is the ultimate filter that separates the truly successful investors from everyone else.
Moving on to Part 2, the safety net. We need to establish your financial base.
Okay, here is your mandatory safety net. First up, you need to secure a 1 to 2 core term insurance policy. That way, your family is fully protected if the absolute worst happens. Second, get comprehensive health insurance, so a medical emergency doesn't suddenly force you to liquidate your entire portfolio at a massive loss. And third, a solid emergency fund to protect against sudden job loss. Without these 3 pillars firmly in place, you're essentially just gambling.
Part 3. What exactly are stocks? Let's look right behind the numbers.
Think of it like a simple factory. Imagine seeing a really successful local factory, and you invest your money to get a slice of their expanding business. They want to build another factory, right? But they need cash. So you provide the capital, and in return, you literally own a piece of that future growth. You aren't just buying flashing green and red numbers on a screen. You are buying a piece of a living, breathing business.
But wait, what if that one specific factory burns down or just goes bankrupt? Well, instead of risking all your hard-earned cash on just one factory, mutual funds let an expert step in and spread your risk across 50 to 100 different companies. It's instant diversification. It acts like a giant cushion against catastrophic losses if a single stock happens to completely crash.
Which brings us to Part 4, the safe path, specifically the Nifty 50 strategy.
For new investors, trying to pick individual stocks or diving into confusing sector funds, like exclusively betting on IT or pharma, is a massive trap. Seriously, don't do it. Betting on the overall growth of India's top 50 companies through a Nifty 50 index fund is so much safer, and honestly, it requires zero emotion. If a company stops performing well, it automatically gets booted from the top 50 and a stronger one takes its place. You are essentially just betting on the broader economic engine of the whole country.
But hey, watch out for this hidden leak that could silently drain your wealth over time. You need to make absolutely sure you choose direct and growth mutual funds. Notice how regular funds quietly siphon off a portion of your gains just to pay agent commissions? Over 15 years, those tiny little percentages compound into a massive, massive loss of potential wealth. It's a total game changer to avoid them.
All right, Part 5, Beginner Traps and Psychology.
Please do not fall for these brutal beginner mistakes. I'm talking about blindly buying SMA IPOs, small and medium enterprises, just because there's a bunch of hype online, or trusting random Instagram tipsters, or worst of all, falling for these massive guaranteed 20 to 30% monthly return scams. Listen, if someone offers you a guaranteed sky-high return, you are exactly one step away from losing absolutely everything.
And this brings us to a completely non-negotiable rule. Always ensure your broker is heavily regulated and SEBI registered. Otherwise, your investment could vanish literally overnight into a complete scam. Never download some random app from an unverified link. Always check the SEBI registration number directly on the official website to ensure your money is actually safe.
To wrap up our analysis today, I want you to consider this really profound metaphor. You don't plant a mango tree and look for fruit the next day. It perfectly captures the psychology of investing. You have to water the tree consistently over time. Digging up the seed every single day just to check on it, that's not investing. That's just destructive gambling. You got to endure the boring periods, provide the sunlight and water, and just let compounding do its heavy lifting over the years.
So as you check your portfolio tomorrow morning, I want you to ask yourself a hard question. Are you patiently building a solid foundation for a mango tree, or are you just gambling with your financial safety for an overnight thrill? Take a hard look at your strategy, secure those safety nets we talked about, and truly commit to the long game. That wraps up our explainer for today. Keep learning, stay patient, and we'll see you on the next one.